Good morning. Welcome to Olivier Blanchard. Today we are going to discuss Prometeia economic outlook of March 2018. Let me introduce you, although you don't really need introduction. Olivier has been for many years at the Massachusetts Institute of Technology in the Department of Economics, of course. Then he has been economic counselor at the IMF during critical years from 2008 to 2015, where he was able to shape the view of how to really address the global economy, both within the fund and I would say largely outside the fund. And now is at the Peterson Institute for International Economic, and not to forget, is also the president of the American Economic Association. So it's really an honor to have you today with us to discuss these issues. Let me mention another issue which is not less important. Most of us as students have been, one way or the other, studied on your books, both undergraduate, graduate, master level. So let me thank you for that. And now I think we can move to this interview today. As said, we are going to discuss the Prometeia economic outlook. There is just one issue that has taken the news suddenly yesterday and today, which is the implementation on tariff on, still to be defined on a number of products from the Trump administration regarding China. Now, we are going to the press now. So our scenario is basically assuming that these tariffs will have an effect, but there's not really going to be a full-fledged trade war, although it would be very difficult to define what a full-fledged trade war is. So what is your sense about how the situation is developing? There are a lot of ups and downs with the Trump administration. The steel and aluminum were really minor issues, the tariff on steel and aluminum. Here we are talking about 60 billion imports for the US out of a trade deficit that is about 360 billion, at least in terms of merchandise. There are different measures. The administration quotes a different number, and the number I've quoted, it's not in value-added terms, and so that would be smaller in value-added terms. Anyway. This first question, the most difficult for you to start.
Good. Well, first, good morning, and I'm happy to be here. On your question, and we just at the start of the action. A lot of action happened yesterday, so it's always difficult to know exactly how things are going to develop. But there's a number of points to be made. The first one is that the mechanical effects of limited trade wars is actually relatively small, and some firms suffer, some firms win. It is not, unless it gets very big from a mechanical point of view, a major macro issue. One footnote here, which is that the trade wars of the 21st century might be quite different from the trade wars of earlier centuries because of global supply chains. We live in an environment in which firms depend very much on suppliers from other countries, and so a country can stop a supply chain much more easily and can disturb the economic situation much more than they used to in the past. But this being said, if it was just a limited trade war, I don't think that would be a major macro issue. The issue is that there can be non-mechanical effects, right? And we saw this yesterday in the US stock market, and we see this morning in the Asian stock markets, which is that it creates an environment of enormous uncertainty. And that can have very big effects on asset prices and can have an effect on macro. So until today, I really thought that although the economy was doing well, the geopolitics were not going to have a major effect on the economy. But now we have to put a positive probability on a geopolitical set of events having an effect on the baseline forecast that we're making.
Olivier, thank you so much. So let's move to the baseline, and let me describe you briefly our baseline, and then let you comment on that. You know, there are a lot of uncertainties, not only related to trade, but to other issues like, you know, U.S. inflation, the political situation in certain countries, including Italy. We'll come to that later, but we had to navigate those issues. And our main baseline, main assumptions, and you know, how do you see that we see the baseline is that essentially the economy is going to be strong this year and probably the next, the world economy. This a lot is related to the fiscal stimulus that the Trump administration is implementing, which at least will, I mean, some of the measure will expire in September 2019, but we know there are presidential election in 2020. So our assumption is that those measures will be actually extended to 2020. And now, of course, the other big player is China. China is apparently moving forward with reforms, but of a slow pace. And therefore, we see, you know, a slowing down of growth, but we don't see, you know, a very strong slowdown of growth. So essentially, we are seeing, you know, a growth that is still going pretty well in the next couple of years, and then slowing down afterwards. Also in relation to, you know, the stance of monetary policy, which we incorporate in our assessment very much in line with the markets more or less are expecting. So do you think this baseline is too optimistic? That, you know, the US has been in expansion for nine years now. When you look at the length of the cycle and the expansionary phase, sometimes you wonder, you know, there have been some expansions that have been longer, but it's not very frequent to have such long expansions. So what do you think? You think our baseline is reasonable, or somehow we are a little bit too optimistic?
I think your baseline is very reasonable. It's very much the same as mine. I think the recovery in advanced economies is a strong one. It's a balanced one. It comes largely from the fact that we had gone down a lot, and that the brakes, which played a central role in the crisis and thereafter are slowly loosened. Credit is available in most countries on fairly easy terms. Fiscal policy is in neutral in most countries, except in the US, where it's actually expansionary. So, and if you look at, you know, whether it's consumption, investment, exports, in most countries, this is very balanced. So I think that the recovery is a strong one and is driven by demand for healthy reasons. The issue is how long can it last? Well, it depends not on history. It depends on how close we are to the wall, to the supply side. And my sense is in the US, we're clearly fairly close to it. So I suspect we'll come back to that. But in Europe, there's still quite a way to go. So I would indeed expect that the next 2 years, leaving aside the geopolitical risk that we talked about 5 minutes ago, I would expect the recovery to continue. Then eventually, you're right, that some of the effects are going to slowly fizzle. Accelerator effects on investment, for example, are going to slow down. But it's going probably to take a couple of years before we have to face a more serious adjustment.
Thank you. Overall, it's a pretty benign outlook. And, you know, in the past, when, you know, the US economy was recovering, or, you know, the monetary policy was tightening, it happened that, you know, some emerging economies would have problems. Here we are thinking about a scenario in which basically is a soft landing, which notwithstanding the fiscal stimulus, monetary policy will be able to stabilize, US output more or less toward potential without any negative externality on the world economy. So do you think, we know emerging markets are in a better position compared to the past, but still not all of them. And do you think we are missing something, that there is some imbalance building somewhere that somehow we are missing?
So I think there can be two types of imbalances. That can be on the real side in the composition of GDP, or they can be on the financial side. And I honestly don't see them. This is not, some of past expansions were driven by housing, and we know that can end badly. This is not the case. One of the main factors at this stage is consumption, but investment is also picking up. And, one of the puzzles of the past was how low investment was for quite a while. And I think that now firms are more relaxed and are going to invest more. So on the real side, I basically see a healthy recovery. I don't see major imbalances. I mean, you have to go country by country, obviously, but in general, I don't see it. On the financial side, people worry about overvaluation of many assets. And there, I think if you accept the notion that the yield curve has it about right in terms of the increase in interest rates, my sense is the major stock markets, for example, are about fairly valued, that they are not excessively valued. They are very high, but given that the rates are still very low and expected to remain rather low for a while, my own research has concluded that there is no major overvaluation. So I don't see it. There are clearly pockets of housing in some countries where you worry. But in general, no, I don't think that the expansion will come to an end because of imbalances. It will come to an end before of old age or accidents, which one of them we talked about earlier. But I don't think that we are building imbalances which are going to kill the recovery anytime soon.
Thank you. Let me move to the issue of inflation, which U.S. inflation, which has been concerning market, especially at the beginning of February, when some data on wages would suggest that inflation might exceed expectation, at least this year. So we have produced this our fifth Prometeia discussion note that I've sent you. I think it's a lot in line with work that you have done in terms of trying to think about inflation through the Phillips curve. Now, what we do as well is try, not only to have a forecast on U.S. inflation based on the Phillips curves, but also try to add, a more granular analysis related to some temporary factors that have affected inflation, in recent months. So I've sent you the note. You might have seen it. And our assessment, not so much concerned on the short run, on which there is, agreement that somehow there are not strong inflationary pressures, in the very short run, but also going forward, we don't really see inflation going above, let's say, expectations. I mean, it's a rather generalistic statement, but let's say that long-term inflation expectations are well anchored, and we see inflation in the U.S. going to target or a little bit above target in 2018, but then coming back below target in 2019. Looking at the PCE, the personal consumption expenditure inflation, which is the target of the Federal Reserve. So what do you think about? Were you concerned at the beginning of February about inflation, or not? And how, after a month of thinking about that, what is your thinking?
So going through the various steps, I suspect that we're going to see overheating in the United States. We don't know exactly what the natural rate is. We know it's much lower than we thought it was, and we can discuss this as well. But at some point, between 3 and 4%, we're going to get to the point where there's going to be more wage inflation pressure. There's already some. It's not very big, but it's there. So I suspect that we're going to see a bit more inflation because the unemployment rate is likely to decrease a bit more and put a bit of pressure on inflation. What we don't know is how nonlinear the Phillips curve relation is, which is it the case that it's very quiet until some point and then suddenly there's a boost of inflation, an explosion of inflation. The only way to know is actually to get there, which we probably don't want to, but based on historical evidence, there is no strong evidence of nonlinearity. So I expect overheating, but I don't expect a major increase in inflation. I suspect that if inflation goes up above 2.5%, then the Fed would feel very strongly that it has to do something. Because for the same reason as inflation is very sticky on the upside, it is also very sticky on the downside, and going down from 2.5 to 2 might be difficult. So I suspect then we would see the Fed react, and I think that implies some probability that the interest rate that they would have to choose, they would have to use in order to slow down demand and slow down inflation, might be higher than what is currently priced in the yield curve.
Yeah, let me ask you, I think the yield curve is pricing this year should be 3 increases by 25 basis points. You think this is going to be too mild as an assumption? You think that some more will be needed?
Again, I think in expectation as a baseline, I think it's probably reasonable, but the distribution around it would not be symmetric. In my view, I think there's more of a risk of having to do more rather than less. There are opinions on both sides, but it seems to me that, again, the US economy has a lot of momentum, and the Fed may find that it really needs to increase interest rates more than it anticipated. We understand very poorly the effect of monetary policy on demand in the current environment. And so, again, my own guess is that the Fed may have to do a bit more. Now, whether it's 4 increases rather than 3, this is the level of detail which I cannot, discuss. I don't know enough.
Thank you. So, but one important element in this discussion is the dollar exchange rate. And there have been concern about the dollar having to weaken even further. The dollar appreciated between 2014 and 2016 toward the end, until the end of 2016. Then during 2017, depreciated or weakened to a certain extent. And if you think about the elements, current account deficit, interest rate differential with Europe being in the US higher than in Europe, and other elements like the fiscal expansion, you might expect the dollar should be somehow weakening even more. I was looking at the other day at the data on imports and imports prices. Import prices have been falling a lot, reasonably so, between 2014 and 2016, and imports in manufacturing have been growing substantially, more than domestic production during that period of time, which is another suggestion, although very partial, that the dollar might have appreciated a little bit too much during the 2014-16 period. So what is your thinking? Because now also this, implementation of tariff might introduce another important element into the discussion about the dollar, and the administration has been talking the dollar up, talking the dollar down. But this is an important element also for monetary policy. So what is your assessment about the dollar going forward?
So I think there's first the issue of whether we can explain the dollar looking back before we actually look forward. And I must admit that I am a bit puzzled by the depreciation of the dollar. If you think about the textbook treatment of the effects of fiscal policy when there's a strong fiscal expansion at a time at which the economy is close to full employment. I think the textbook answer is, well, the Fed will have to react, interest rates will be higher, and the dollar will be strong. Now, in fact, if you go to the chapter later in the textbook, you actually find that you have to qualify this because there are two effects, right? There's indeed the interest rate differentials, and they are there, and they are expected to last for quite a while. But you also have a sense that a larger fiscal deficit will mean a larger current account deficit, both in the short and the long run, and that has to be financed. And so eventually there has to be a depreciation of the currency in order to reduce the current account deficit. And this is in an environment in which there are questions about whether the world will be willing to continue to buy dollar assets. I mean, the big buyers were the Chinese and the OPEC countries, and their current account surpluses are smaller, so they have less to invest. They are looking more at diversifying away from the dollar. So I think there are fundamental factors which suggest dollar depreciation, and the question is whether they offset the factors such as interest rate differentials, which go in the opposite direction. It's a fight, I think, between the two. My guess was that the interest rate differential was going to dominate, and thus I was surprised by the dollar depreciation. But having seen what I have seen, I've concluded that markets may be more worried about the current account deficits in the medium run, the lack of demand, of flow demand for dollar assets in the medium run, and that may be explaining the dollar depreciation. So which way it goes, I suspect that if we have larger current account deficits, which we may, because of the fiscal expansion, that might actually lead to a continued depreciation of the dollar. But on these things, as you know, it's very difficult to tell. We really have two forces playing against each other. So far, the depreciation has dominated. Whether it does in the future, very difficult to say. I wish I could give you better, more specific forecasts, but it is really a very difficult issue.
No, thank you so much. I think thinking through the issue is already, with your experience, is already very important for us. Let me give you a clue, a very partial clue of why I think the dollar weakened at the beginning of 2017. I think this is related in part to what happened in Europe with the sequence of elections during the first part of 2017. So we had the Dutch election, but then of course the French election. And then at the time, if you look at the data, the dollar started to weaken, partly because I guess the political risk in Europe was decreasing. But of course it's very difficult to establish causality. This is just a simple correlation. But this brings me to the issue of Europe, which I would like to address next, and the issue of the euro area governance reform. So basically, probably, the discussion is starting now with the new German government in place, and there are a lot of issues on the table. Some of them are economics, others, of course, are not strictly related, like border control or other issues. But the thing is that there is a need to prioritize, and the prioritization will depend on which view will prevail. So let me first ask you a pretty general question. So what do you think are going to be the priorities of our policymakers? Even within, completing the banking union, there are a number of issues like, the common deposit insurance, reducing holding of government bonds in banks' balance sheets. There are a number of different issues. So how would you approach the problem?
First, let me go back maybe to the dollar in response to your response, if it's okay. Well, in retrospect, you can always find explanations for why a currency went up or down. And I think that there's a set of factors which go again both ways, looking back. One of the things we have learned in Europe is that it's very difficult to increase inflation. And I think that reflects the fact that, in fact, the natural rates of unemployment in various countries are probably lower than we thought, that there's not much wage pressure. But what this means is that interest rates in the Eurozone are likely to remain lower than we would have thought, say, a year ago. That tends to go in the direction of dollar appreciation. At the same time, now let's go to the tariff war, which we talked about at the beginning, right? Again, the textbook says, if there's a tariff war, you're going to get less imports. You're going to get an increase in domestic demand because you're not importing the goods anymore, and the Fed will have to intervene and basically increase interest rates to avoid overheating, and therefore the textbook answer is a tariff war is going to lead to an appreciation, which is going to cancel the effects of tariff. So again, that element would lead to a dollar appreciation. But then there's a twist, as there's always a twist, right? Which is, well, maybe this tariff war is an indication of incompetence on the part of the policymakers, of great uncertainty, and great uncertainty may affect the dollar more than other currencies and lead to dollar depreciation, which is an argument that Larry Summers has made in writing, I think 2 weeks ago. So there are all these elements, and I think they all play a role in one way or another. How they add up looking forward, again, I don't know the answer, but I think you have to keep track of all these factors in thinking about the future. Let me now move to Europe and your question, which is, I don't think that from a governance point of view, Europe is in such terrible shape. And the question is, what is absolutely needed to make it function, as opposed to what are all the dreams that we may have about where it could go and how it could be better. And I find that there's a lot of dreaming in the discussion. So if I had to choose two issues where I think Europe really has to do something in order to protect itself against various risks, the first one is completion of the banking union. Been a long way already, but there are still things to be done, and I think it has to be finished. It's more the completion of the financial union than the banking union, but that seems essential. We've understood the complexity of financial crises, and we have to make sure that we can limit the next one and handle it if it comes. So I think that's one. I don't think that this one is controversial. The other one, I think, is more controversial, which is my sense is that there has to be in place a crisis mechanism and a debt structuring mechanism. At this stage, it is still very difficult to know what would happen if a country got in fiscal trouble. Some investors still hope and believe that there will be some bailout. Some investors believe there'll be bail-in. It's very difficult to price the sovereign bonds in that environment. And it's also very dangerous because it doesn't give the market the right signals. So here, I'm very much for a bigger role for the ESM in case something serious happens, so that they can do kind of an IMF-like program. We're not there yet. And also for very clear and credible rules for debt restructuring where to be necessary. What this seems so clear is just a set of principles, which is first you have to look at whether there is a solvency issue and whether it can be solved without debt restructuring, or it requires debt restructuring. But credible has to do with other aspects, which is a well-known issue, which is the proportion of sovereign bonds on bank balance sheets. If banks have a lot of national sovereign bonds on their balance sheet, then the credibility of a bail-in is much lower, and that's a big issue. So I think they're dealing with how much banks can have of their own national sovereigns on their balance sheet is also a high priority. So these are the two dimensions in which I very much hope there is progress. For the rest, for the fiscal unions, for redistribution. It would be good, but realistically, it's not essential, and it's probably not going to happen on any substantial scale.
Thank you. Let me react a little to this. The restructuring issue, we are not, I don't think any European or Euro area country is really in the position to even consider that, especially not Italy, and given the systemic importance, given the interlinkages of financial system across Euro area countries. Italian public debt is too widespread to consider a restructuring. And I'm not saying that eventually or theoretically it's not, the way to go, but it might take a long time, and it might be helpful to think how to introduce some elements that might reduce the cost of going into this direction, like common deposit insurance would be a classical example, or funding the resolution funds for banks would be another clear example. So basically the two things have to go together, and this is a little bit the issue, that it's very difficult to move one issue forward without moving the other, but there is disagreement on which issue to move. So certain countries don't want risk sharing, and so it becomes more difficult to move forward on, for example, automatic restructuring when one country applies for an ESM program.
So let me clarify a bit. I was not suggesting that there was any need for that restructuring, in particular of Italian debt restructuring at this point. And we can discuss this more. But it could happen in the future, and it will happen at some stage in the future, that some country will be affected by a bad shock or have a government which behaves irresponsibly, and the issue of that restructuring will come back. I will make one exception to that statement, which is Greece, where I'm absolutely sure that there has to be debt restructuring. And I've started saying this when I was still at the fund, and it was the early 2010s, and I still believe it even more today. I think there's no way Greece can return to markets with the level of debt it has and survive. But leaving aside Greece, I do not see any need or desirability of debt restructuring at this point in any of the Euro countries. I also do not mean automatic debt restructuring. I don't believe in automatic debt restructuring. I suspect that the way it should be done is the way the IMF does it, which is a country is in trouble, having a hard time finding investors. Then it goes to the ESM, and basically the ESM looks at whether some measures can re-establish credibility, or where there's a need for suspension of payments or straight debt restructuring. And that's a decision which is made using a very large number of qualitative elements. That's the way the IMF does it, and that's the way it should do it. On the risk sharing, we have to be more specific as to what it means. I agree that deposit insurance is an essential part of the puzzle. I think that national deposit insurance can actually be done. It's not ideal. I would rather have euro level deposit insurance. But even if it doesn't happen, I think that national deposit insurance might be enough. That's the amount of risk sharing that I think is probably realistic. Not everybody agrees, but I think it can happen. But beyond this, the larger schemes for risk sharing, which is when a country has difficulties, it gets gifts or generous loans from other countries. I think we have to be realistic. It's not going to happen. and the countries have to do it on their own. They basically have to reestablish some fiscal space and credibility so that they can borrow in markets when they need to. This implies, I think, more of a role for markets to give the signals and to be convinced that things are okay, and less of a role for the millions of rules that now exist, which constrain fiscal policy, I think, too much in many cases.
Yes, this I'm just moving forward on what you are saying and thinking about the ECB QE will be ended, and the QE has been really an issue in the sense for sovereign debt yields, in the sense that has been compressing spreads a lot, and so this implies, what you're saying implies, and it makes sense, that going toward the end of QE and after, if this is the view that is going to prevail, we'll see some opening up of spreads. Now the question is how much, and it's going to be difficult to price. And the thing is that monetary policy will remain the only backstop for the euro area as a whole and for any redenomination risk. So there's going to be a tension there between letting the market with all its volatility be determining the spreads and keeping the euro together through monetary policy. And I cannot see, I have to think about exactly which way the euro area is going to take. Any views on that?
Yeah, on monetary policy, it's a backstop for some things, not for everything, and it shouldn't be. No, but one has to make a very important distinction between liquidity needs, which the ECB can actually handle, and solvency issues, which the ECB is not in charge of solving and cannot solve. So, yes, I think monetary policy has to be such that if there is, a sudden stop in one country, which is largely self-fulfilling potentially, then the ECB can do something. But if a country really is in solvency trouble, which again, no country at this stage except Greece is, then the ECB cannot, doesn't have the mandate, doesn't have the instruments to do it. And so I think there are limits to what monetary policy can do. And you're right on the other point, which is that as QE has slowly decreased, we don't know what the ultimate balance sheet of the ECB is going to be, but it's likely that the spreads on various euro member bonds are going to increase, and that's going to make the fiscal situation a bit tougher. Not incredibly tough in most cases, but tougher, no question about that.
Okay, let me move to the last issue I would like to touch on, the European issue, which is the euro bonds, or I see basically three layers of possibilities. The first one, or maybe four, I don't know. The first one is a really federal program or federal entity issuing union bonds, which I think would be what we should strive for. The second is some form of joint liabilities on some part of sovereign debt. The third form is just a synthetic, maybe market-based bond that basically includes shares of euro area sovereign bonds. And the fourth is nothing. So this is the four layers that I see. And of course, is all related to, there are a lot of issues here it's very difficult to address all these issues in a few minutes. But I see two major issues. One is the one related to banks' balance sheets. So which type of safe asset we want banks to hold. And I think this is a very topical issue. And the second issue, which I actually maybe is less relevant, but if the euro has to establish itself as a international reserve currency, you need to have one safe asset at the euro level, which is going to prevent also internal fragmentation in cases of crisis that we have seen, for example, in 2011, 2012 with the euro area debt crisis. What do you think about that? Should we have one common bond, or should we strive for that, and how together?
So, two main points. The first one is it would be great if there was a EU budget and euro budget and euro bonds at the federal supranational level. It's not going to happen. My sense, and so that's the first point, it's not going to happen. The second is, despite the fact that the crisis has given it a very bad name, I continue to think that securitization in general and trenching within securitization is actually a set of two good ideas. And I would be perfectly happy with a private sector solution to the problem. It seems to me that some of the proposals which basically securitize and trench would provide a safe asset, and the private sector could do it on its own. Now, the issue is, I think, not conceptual. I think it could work, and if the trenching is very prudent, then I think the most senior trench could be really totally safe. I don't think, even if some governments at the margin are going to default, you can really make the senior trench completely safe and fairly transparent, as opposed to the MBS in the US or something like that. And I think the issue is then a regulatory issue, which is would these be considered safe assets by the regulator? And as you know, there are issues here, which is regulators may be reluctant to do so, but that seems to be, an administrative issue rather than a conceptual issue. So I'm basically fine with the private sector issuing these trenched securities and the regulators accepting them as safe assets in the portfolio of institutions, banks, and others. So I'm totally happy with that solution, and I would try to make it happen by changing regulation if somebody wants to try.
Very clear. Olivier, I would have one last question for you, and then give you the opportunity, if you have any question to us, to ask any question, because also I think Italy in this moment is a little bit, under the radar screen of the international community, at least for political reasons. I'm not going to answer about political questions, but maybe some technical issues that you might be interested in. My last question is really a general question. If you look at the last 10 years, you really see, the crisis, kicked. Then there was fiscal policy reacted also, thanks to IMF and also your impulse. But that was a short-lived reaction. Then there was fiscal contraction. And during those years, monetary policy has done the heavy lifting, basically. And now, I think for a number of reasons, this process is coming to an end, not only because inflation is slowly coming back to target, but also because monetary policy has some distortions, if remains expansionary for a long time. And also there are all these issues about distribution of income that really monetary policy cannot address. And actually, although there is not strong evidence, it's not really clear. You have argument that would suggest that easy monetary policy reduces income distribution, but you have also other argument that easy monetary policy increases income distribution. So, but apart from that, the bottom line is that monetary policy is getting, to job done type of approach. And although with the exception of the United States that is implementing a large fiscal stimulus, it doesn't look like that many advanced countries have fiscal space, to come back to, fiscal expansion. And growth is sluggish, productivity is very low. There are demands, for more employment, more growth, more income distribution. How policymakers are going to address this issue? I mean, how do you think?
There's a difference between how should they and how they will. But and you've opened a very large set of questions, and so let me pick and choose. So to me, the main lesson of the crisis is the importance of the financial system. Now, that's not a very deep insight, but the financial system is quite different from the rest of the economy in the sense that when you think about the rest of the economy, for example, the behavior of consumers, you do not need to understand how consumer A affects consumer B. You can basically assume they all kind of act the same way and look at some big consumer and estimate, a consumption function, something that you might be doing. When it comes to the financial system, granularity is of the essence, which is that actually the way the financial system works depends enormously on the plumbing. And you have to understand the plumbing very well, and it's a very complex plumbing that even the plumbers themselves don't quite fully understand. And so it makes macro theory and macro policy much more complex because you have to keep a level of detail to actually understand the dynamics, which is completely different from what we did before the financial crisis. So I think that's the main challenge, both to theory, macro theory, but also macro policy, which is how do you do financial regulation? How do you do macroprudential policies? Can you have the information sufficient to actually do a good job? And it's very far from obvious that we are there. So to me, that's the main challenge. The second is, by default, monetary policy had to do the heavy lifting, and it has discovered a number of instruments, QE, negative rates, and these instruments might well be useful even in more normal times. And I think there'll be a lot of work on trying to find out what do we keep for normal times and what do we use only when things go really bad. So I think it's good news both on the theory front. Academics are doing a lot of good work, but also on the policy front. The central bankers, for the most part, have been very good at trying things and seeing whether they worked or not. Fiscal policy is interesting. So in the heat of the crisis, we got the countries to use fiscal policy, right, at the beginning of the crisis, and then they turned to what they call austerity. Now, there was obviously a need for a reduction in the fiscal deficits. I mean, they were much too large. Whether it went too far or not can be discussed, but there had to be an adjustment. But what is striking there is how little work there has been both among academics and even more so among policymakers about how to improve fiscal policy. For example, something that I've pushed for a long time, even before the crisis, but even more so since, is automatic stabilizers. And it's clear that if we're going to be very close to the zero lower bound for monetary policy, it would be good to have something which can react quickly and does the job in the short run. There has been zero progress on this. Now, is there a lot of fiscal space beyond that? Yes, debt levels are very high in many countries, including yours, but the interest rates are very low. Now, they are low partly, in your country because of QE, but they are low in general. They are low in the US. So the interest rates are actually lower than the growth rates in nearly all advanced economies. So what this means is that from intertemporal budget view, things are not dire, and you can basically have larger deficits, and your debt is not going to explode because the interest rate is so low. So I think we're in an interesting situation in which the levels of debt are very high, but again, the cost of debt service is very low. And the interest rate is lower than the growth rate. So I wish there was much more work on fiscal policy, both in academia and in the ministries of finance. Maybe it comes, but at this stage, To use Latin, I've been vox clamantis in deserto, and that's the extent of my knowledge of Italian by proxy. But that's disappointing.